Talk of the tape, are these expectations too hot or are they just right? Let's ask MJP's Brian Vendig, 314 Research's Warren Pies, and CNBC contributor Sandhill Global Advisors Brenda Vingello. Welcome to you all. So Brian, I'll pose that to you. You know, a client comes to you, says, want a great 3-year run. Some of the leading stocks are up huge. Maybe I have, heavy allocation to equities. What are we doing now? Are we adding risk? Are we subtracting it? Are we just moving it around to other areas?
Well, I think, Mike, the fourth quarter is a great indicator of that because I think investors are being a little bit more conscious about valuations and making sure that they're not overpaying for growth. Because we've seen in the short term, obviously, valuations stretch on the growth side of the house, but we've also seen earnings come out for next year, expecting 15% growth year over year. More contributions coming from areas outside of tech. And I think also when you think about it, tax incentives, deregulation, neutral Fed, that plays a little bit more into the cyclicals. So financials, industrials, real assets, catching a bid. And I think investors are thinking about positioning. So that's I think, where investors are going into 2026. So
you would essentially ride that type of a rotation into next year?
I don't think this is the backdrop to pull off of risk. I think the key is diversification and also making sure that you're watching the yield curve, because I think the one thing in the horizon is if yields get above 4.5% on the 10-year, we have seen that as an indicator of a risk-off sentiment, but we're not there yet.
We are not. And just to amplify your point, and, Brenda, we can start here. The S&P over the last basically 2 months is essentially flat. We got the 6,900 in the S&P late October. You've seen financials up about 5% since then. Transportation stocks up 5%. Software down 7%. Home builders down. Of course, crypto has had it rough. So how are you viewing things in terms of whether this is just kind of a stutter step in the tech-led rally, Brenda, or is it an enduring change?
I don't think it's enduring change, but I think it's healthy to have a little bit of a pause, especially on the tech trade that was responsible for so much of the strength that we saw from April really through September. But I do think when we look at fundamentals, I think the story continues to be strong. Our concern is that is very well defined, and everybody is expecting 2026 to be a strong year. And generally, markets perform best when there is some level of skepticism, which maybe we've had a little bit of that in the tech trade more recently. But nevertheless, when there's a little bit of skepticism and there's room for upside surprise. And when we look at this coming year, we have projections for mid-teens earnings growth for the S&P 500. Valuation is elevated. Expectations for economic growth are high. So we have to ask ourselves, where is the upside surprise going to come from? And I think it could come from areas outside of tech if other companies and industries can really figure out AI. And what we saw over the summer, especially with the MIT survey that came out, is a lot of companies were working with AI, but not having a lot of success. So if we start to see that success grow and manifest itself in better profitability in some of those sectors outside of tech, then I think that could be where the surprise comes from. But we think it's really important to stay disciplined in this environment. And so we have generally been trimming equity as markets have been at or near all-time highs, and we expect to continue to do that as next year progresses.
Well, Warren, I mean, I guess you're kind of in that camp of folks expecting further, kind of good things here. The 7,850 on the S&P, your year-end target for next year. What gets us there in your view?
Yeah, I mean, I think you have, when you stand at the beginning of a new year, you have kind of a process of elimination you go through, because we're never going to see all the wiggles that happen throughout a year. So we have the big picture is Fed is easing. I think that's pretty well known. It's just a matter of how much, 2, 3 cuts. We think 3. We don't see a recession. I mean, there's been some fiscal contraction, but we still have, historically high fiscal deficits, and we think those will expand in the first half of the year due to the big, beautiful bill impacts. And then we have earnings growth accelerating. We have Q4 earnings estimates. This is really important. Q4 earnings estimates have accelerated, and that's not what you see usually seasonally. This is the fastest acceleration of Q4 earnings we've seen since the post-COVID recovery in 2020. So when you put all that together, it's really hard, in my opinion, to construct a bear case. I understand the valuation point, but we've looked at that, and they don't concern us. In fact, I think what we see is margins expanding by 90 basis points, the Fed cutting. And so, again, we've never seen a year historically where multiples even contract under those conditions. And so it's all lined up. I think the Goldilocks environment that we've been in really post-Liberation Day is going to be with us at least through the first half of the year. That's when I think all of the cyclical disinflation that's in the pipeline continues to come through. If there's going to be a problem next year, I think it's going to be later in the year when we start to identify the end of the Fed's cut cycle, and the rates market's going to have to reckon with what that means exactly, and the yield curve may normalize. But up until that point, I think it's there are pretty strong tailwinds to the bull market.